Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, May 24th. How are you doing? I hope you had a good trading week. Hope you had a good week in general, and I hope you're having a great weekend. And I appreciate you coming to my weekend review podcast, and I hope you are going to find it helpful. I think I have some really good content and some good potential trades for next week that I am looking at. But market was down a little bit last week after this big run up. I'm not surprised. Actually, was looking for more shorts because I did take a short last week, but I am looking for more shorts, and I'll explain why as we get into the podcast. But yeah, I mean, we had a big move up. We had some sideways motion. We got up to some significant overhead resistance level, multiple, and market stalled out, and now it's coming back down. So the format for today is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades and positions that I have from last week. I made some new entries, made some exits, have some current positions. But we'll talk about why I entered the trade, what the confluences of signals were, what the setups were, but basically why I took the trade. I'm going to talk about how I manage the trade going forward, which is always the most important. How I set my position size, how I place my emergency stop, how I place my end of bar stop, how I take partial profits if the market moves in the direction that I want it to, and then ultimately, like this week, how I exit the trade when it gets to significant overhead resistance levels. So I hope that's going to be helpful for you, give you an idea of how I look at trading, how I look at entries, how I manage the trade, how I exit the trade. And after that, we're going to talk a little bit about trader psychology. Folks, it is the most important part of trading. Really, when it comes down to it, is the ability to create a plan and follow the plan. And I've been trading for over 30 years. And listen, I've been through it. And I know every day that goes on, more and more, I'm like, you know what? You have to have basically a black and white plan. And if the market does this, you're going to have to do that. If the market does that, you're going to have to do this. Look, it doesn't have to be the best plan in the world. You don't need 100 PhD mathematicians creating this plan for you. That's what a lot of retail traders misunderstand, is they think you have to have this one great setup plan that's the holy grail of everything. For one, it doesn't exist, and two, you don't. You just need a basic, decent plan that you follow, and the following part is the most important. And so that comes down to psychology. And that's why I like to talk about trader psychology. So hopefully that's going to be helpful for you. I always like to teach it. It helps me, and I hope it's going to help. It's interesting because the more that I teach, the better trader I become, because I'm always teaching my students all these basic principles, right? And the more I teach them, the more I go, oh yeah, well, I better follow that too, right? And of course I do. I do, but it's interesting that teaching makes you a better trader. So start teaching trading, right? I'm not really joking. Teach your friends, share with them what you learn, and it will reinforce your own trading habits, good habits. So, all right, so we're going to take a look at my trades, when I entered, why I entered, how I'm going to manage the trade going forward. We're going to talk about trader psychology, and then we are going to take a look at potential trades that I have setting up for next week. So every Friday, I go through my watch list. Every Friday night, I go through my watch list, and I look for potential trades for the coming week. And I look for markets that are getting close to some really good confluences and signals of support if I'm going long, and resistance if I'm going short. Now, they're not where they need to be yet, but as retail traders, our number one advantage that we have over the large financial institutions is we can sit and we can wait for a market to get right where we want it to. And that is a big advantage. They're always having to buy, they're always having to sell. They can't do that. But there are certain sweet spots in the market where you have these confluences of signals come together where if it gets to that level, I don't know how you do any better than that, right? Doesn't mean even if it's the most perfect setup in the world, doesn't mean it has to work. But more times than not, it does work, and that's what we're looking for. So I've identified some both on the daily time frame and on the weekly time frame that are getting to some pretty significant levels that would be, for me, a good entry, a good structure of the market that helps me structure a good trade based upon a good risk to reward ratio. All right. So if I'm wrong, I can be wrong small. If I'm right, I can be right big. And that's really what it comes down to. So anyway, I hope this is all going to be helpful for you. If it is, I really would appreciate if you could hit the thumbs up button. It really does help to build the channel, keep the channel around, lets YouTube know that there's some valuable content. And it only takes a second and it's free. And if you have not subscribed to the channel, I would appreciate that too. So let's run this U.S. legal disclaimer and then we'll get started. Hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right. Thanks for holding through that with me, and let's get started, everybody. So I have some current open trades. I have some current close trades. We're going to go through. We're going to talk about why I entered these and so forth. So let's start off with Google. Got my little handy calculator over here. Now, I've had a great trade on Google. Really wonderful trade. And I entered Google down here on the 6th of May at 151.47. So the first question is, why did I enter here? Well, this green box here is called an order block. And you've heard me talk a lot about order blocks. You must learn about these, really, because I don't just trade off of order blocks. I trade other signals within order blocks, but they just improve the chances of your trade dramatically. You know, I use the deep dip buy a lot, 200s, 250s, 30 RSIs, so forth and so on. But if those deep dip buy signals happen while they're inside an order block, it makes them so much stronger, just so much stronger. But anyway, the reason I entered the trade was because we had the rejection of this order block. So let me explain further. So what is an order block? An order block is your lowest bar close right before market structure change. So what does market structure change mean? Well, a market structure change, the first thing we need to have is a swing low. And you can see over here, we have a swing low. That swing low has to be followed by a swing high. Here is a swing high. And now you have to have another swing low that's lower. Or as one of my students, Steven, says, a swing low low, right? That's a swing low low. So a swing low followed by a swing high followed by a lower swing low. Now, once you have this pattern, once you have this configuration, you go to the left to your first swing high. Remember, this is a swing low, this is a swing high, this is a swing low. Here's your swing high. If in the future the market goes up and takes out, or in other words, goes above that swing high, now you have a market structure change to the upside. And once this happens, and it happened on this day, now I go to the left and I look for the lowest bar close prior before the market structure change. So swing low, swing high, swing low, market structure change. I look to the left. Where is, oh, geez. I look to the left for my lowest low close. And now that defines the high and the low of this bar, defines the order block. Going forward into time, if you come back into the order block, that is the buyable area. And people do this a lot of different ways. Traders do a lot of different ways. If it just gets in the order block, they'll buy it. If it rejects the high of the order block, they'll buy it. If they reject the bottom of the order block, they'll buy it. Well, I entered here on this day, on the 7th, when we came into the order block and closed back above. You see how we rejected the order block, but on a closing basis, we closed back above. So I entered here at 151.47. It also happened here. This was a buyable area here, and you can see that it bounced from that area as well. So I entered here 154.47 with the rejection of the order block. Now, the first thing, the most important thing, everybody, really, is your position size. And I do this each week, but it's so important. I like to do it every week. How do I come up with the correct position size? It has to do with two things. It has to do with the value of the 2 ATR. Right here, you can see the value today is 1040, and how much money I have in my trading account. So let's say I have $100,000 in my trading account. 1% of 100,000 is 1%. So I take 1% of whatever I have in a trading account. If it's a million, it's 10,000. It's 500,000, it's 5,000. If it's 100,000, it's 1,000. If it's 50,000, it's 500, right? So 1% of 100,000 is $1,000. I divide that then by the value of the 2 ATR, 1040 divided by 1040 tells me to buy 96.15 shares, so I round that down to 96 shares. So for me, this is the appropriate amount of shares based upon a $100,000 trading account and dividing it by the value of the 2 ATR. Why is that important? Well, the value of the 2 ATR shows you what the volatility of the market is. When the market is very volatile, this number is going to be higher, and therefore your shares are going to be lower. If the market's not volatile, this number is going to be smaller. You're going to have more shares. So you have to You need to change your position size based upon the volatility of the market. If you usually trade 100 shares and the volatility is 1, fine. But if the volatility increases by 3 times, now trading that 100 shares is really like trading 300 shares, right? So you have to adjust. So if you usually trade 100 shares and volatility rises 3 times, you should only be trading 33 shares, all right? So 1% of $100,000 divided by the value of the 2 ATR tells me to buy 96.15 shares. So this is the proper amount of shares for me based upon the account and the current volatility. So as soon as I enter the trade, 151.47, I then take the value of the 2 ATR minus my entry. So I just take my entry price minus 1040, move down here. This now is my emergency stop. And if my 96 shares move $10.40, how much have I lost? I've lost $1,000. So when you do the math on this, 1,000 by 1040, it's 96 shares. If 96 shares move 1040, $1,000, right? So I always need to set an absolute worst case scenario for me, and it's my entry price minus the 1040. And if it did come down here, how much would I lose? I'd lose 1% of my account. Not fun, but recoverable. But the good news, everyone, is that this only happens about 5% of the time. Only 5% of your trades will you actually hit your emergency stop. The other 95% of the time, if you have a losing trade, it will be because of your end of bar stop. And my end of bar stop is a close below the low of the order block. The low here is 145.38. So going into the trade, worst case scenario, 5% of the time it will hit my emergency stop, in which case I will lose 1% of the time of my account. 95% of the time, if it closes below my end of bar stop, I'm going to lose much less. And you can see this is emergency stop, this is end of bar stop. All right. Okay. So I have, I got the rejection of the order block. That's my entry. I position size like I just showed you, taking the 1% of my capital divided by the 2 ATR. I place my emergency stop. I know where my end of bar stop is. Okay, so it starts going down. I know what to do. The next thing that I do is I take my entry price and I look for the value of the 1.5 ATRs. Now the value of the 1.5 ATRs is $7.80. So this time I take my entry price plus $7.80. I put the trailing stop level 1.5 ATRs above my entry, and this is my orange line. And so I use this so that in the future, if I ever get to this trailing, it's called a trailing stop level. If I get to my trailing stop level, now I'm in trailing stop mode, which means that now in the future, if I have a close below a previous bar's low, I'm going to get out of half of my position. You hear about tightening up your stocks as the market moves in your direction. Well, this is exactly what that does, right? When it moves 1.5 ATRs above my entry price, then I go into trailing stop mode. And then if I have a close below previous bar's low, I get out of half. In essence, that moves all the stops up because I'm going to be taking half the position off, and that tightens everything up. All right. So, and I'll go through this trade big picture here in just a second. So everything that we have talked about so far, the position sizing based upon volatility, placing my emergency stop, placing my end of bar stop, going into trailing stop mode. All of this has to do with taking action if the market goes against me. If it goes down to my emergency stop, that's against me. If it goes to my trailing stop, if it goes to my end of bar stop, that's against me. If I have a close below previous bar's low after reaching trailing stop level, that is against me, which is great. I need to have those in place. Those are all defensive moves, but I also like to play offense as well as defense. And let me show you how I do that. I play offense by taking partial profits each day if the market moves a certain amount in my direction from the previous bar's close. So let me show you how I do this. I'm still in this trade. I'll show you exactly what I'm doing for Monday. The first thing I do is I take my closing price. Right now, the closing price on Google is 168.13. So I take 168.13, and now I look, what is the average true range, 0.45 average true range? It's $2.34. So I look at the 0.45 ATR, look for the value, it's 234. I take my closing price plus 234. My first profit target for Monday is 170.47. So I will put a limit order in at that first profit target for 10% of however many shares I have remaining. If I have 50 shares remaining, I put an order in at 170.47 for 5 shares. Okay, 10% of however many I go into a day. If I have 100, it's 10. If it's 1,000, it's 100. Right? So my first profit target, 168.13 plus 2.34 is 170.43. If I get there, 10% of however many shares. Now I always place 3 profit targets. So 170.47 is my first profit target. I do it again, 170.47 plus 2.34. My second profit target for Monday, 172.81. And I put another 10% at that second profit target. And then I do it one more time. My second profit target, 172.81 plus 2.34. My third profit target for Monday is 175.15. Again, how much? 10% of however many shares I went into the day with. So I do this every single day. Does it mean I hit profit targets every single day? No. If it goes down, I don't hit any, right? But if it does go up and I hit one, great. And a lot of times, well, I'll show you. Where it gaps up, I hit maybe 1 or 2 and then reverses. Well, I'm sure glad I got rid of a couple up there. Taking profits, partial profits, is so important in so many ways. Because as you take partial profits throughout your trade, essentially you are bringing up your You are tightening up your stops every single day by doing that. You're reducing your position size. You're reducing the stress in your trade. And when you reduce those things, you reduce the stress and the heat and all that comes along with it. It helps you to better follow your trade. That's all I can say. The fewer shares you have, the more likely you're going to follow the trade perfectly. And another bonus, as you take partial profits, if you have a big, huge reversal, you are so glad that you sold some. So glad. And it helps mitigate the loss. So, with any sports team, you need to play offense and defense. And in trading, I look at it as a sport. So I play offense and defense. Okay. So we got the basics, and going forward, I'm not going to be this detailed on all of the trades, but let's take one more look at it. We have a bullish order block. On the day that I took the trade, it rejected the bottom of the order block, closed back above. I got long 157.47. I position sized correctly based upon the volatility in my account size. I placed my emergency stop 2 ATRs below. My end of bar stops are closed below the low of the order block. My 1.5 ATR trailing stop level is 1.5 ATRs above my entry. The next day, it goes up. I hit a profit target. Great. Next day goes down. No profit targets. Next day up again. Multiple profit targets. Next day up, gets to trailing stop level. Now that means if I have a close below a previous bar's low, I'm going to get out of half. Next day, big ups. Multiple profit targets. Now I'm in trailing stop mode. Next day, down a little, no profit targets. Next day, gaps up, I hit a profit target. Next day, down, opens down, closes about even, maybe a little up, but did not close below the previous bar's low. Then here on the 20th of May, it closes below the previous bar's low. What do? I get out of half because I got to trailing stop level. When I get to trailing stop level, if I have a close below the previous bar's low, I get out of half of the remaining shares. On this particular day, I locked in a gain of 7.56% on half of the position. Next day, up biggie bigs, hit multiple profit targets on this on the way up. Next day, up again, multiple profit targets. Okay. The way that I trade, the way that I teach trading, I have rules for everything. And earlier I was talking about how to get out of a position if you get to significant overhead resistance levels. Well, on this day here, on the 22nd, the RSI level got to a 65. If I ever get to a 65 RSI level or higher, then the 5 EMA, which is the blue line, comes into play. So if I get to 65 RSI level, now in the future, if I ever close below the 5 EMA level, now I'm simply out of the trade. Okay? You can see on Friday, we closed barely above the 5 EMA. So it kept me in the trade. Monday, if it closes below, I'm out. Monday, if it goes up, I take partial profits if I get there. If we get to a 70 RSI level, that's another significant overhead resistance level where if it rejects that, I'm going to get out of half of my position. All right. So I have a lot of rules. My students will understand this, that I teach them a lot of rules. And so we're getting close here. So very easy trade from here on out for me. If we close below this 5 EMA, I'm simply out of the trade. If we go up, reject the 70 RSI, then I'm out of half, right? So again, you have to have if-then statements. If it does this, I'm going to do that. If it does that, I'm going to do this. Okay, so the remaining shares on the position, I took half here on the 20th of May, and the remaining shares on the Google trade up 9.89%. Really, really good trade on Google with the order block. Okay, let's go to Amazon. Okay, so Amazon, this is a short position, and you can see the red box up here. And you're probably thinking this is one of Greg's order blocks. It's not. This is a different type of trade. These three bars are what is called a bearish island reversal. And if you want to learn more about bearish island reversals, bearish abandoned babies and island reversals are essentially the same thing. A baby is one bar, island reversal is two or more bars. But this island reversal happened because we gapped up. There was big news, right? Just whatever it was at the time, we gapped up in the morning very, very high. Then we moved sideways for a couple days, and then we gapped down. So when you get a gap up and a gap down, that's called with multiple bars, that's called an island reversal. Go to my YouTube channel, check out the video there. We'll go into more detail. I don't have enough time on this video to explain all the details, but it's free. It's on my YouTube channel, Abandoned Babies, Island Reversals. But this is an island reversal because it's more than one bar. We gap up, sideways motion, gap down. Okay, when that happens, when this pattern happens, and you look out into the future, more times than not, you are going to be lower. If this island reversal happened the opposite, it gaps down, sideways gap up, you look into the future, more times than not, it's going to be higher. So on this particular trade, I don't phase out, I don't have trailing stop levels. For babies and island reversals, I do the following. It's very simple. So I position size as normal. Because I'm short, I place my emergency stop 2 ATRs above, and I place my profit target 4 ATRs below. So let's say I'm risking $1,000. If I'm wrong, if I'm right, I'm going to make $2,000. And that's the key. You have to have a good risk to reward ratio, so asymmetrical risk. So when you lose less than when you make. And in my experience, over 70% of the time, this pattern, I make twice as much as I lose. That's pretty good, right? Doesn't always happen, but in my experience, the abandoned babies, the island reversals, over 70% accurate that I'm going to hit my 4 ATR profits target instead of hitting my 2 ATR stop loss. So that's it. Well, I just set this and forget it. I place my stop here. I place my profit limit order here, and that's it. But we gapped up, sideways, gap down. I got short 205.90, and I don't even have to look at this trade. It's for sure one way or the other. We're going to get up here or get down here. And so it's kind of a nice, easy trade I don't have to manage based upon this bearish island reversal. So this trade doing okay on the short side, up 2.41% so far in the trade on Amazon. UNG is natural gas. Well, if you've been watching this channel, I have talked about this for a couple weeks now, that you see the green box down here. Well, that's an order block. Again, why is it an order block? Here's a swing low over on the 22nd, 23rd, swing high. 22nd, swing low. 23rd, swing high. Another swing low on the 24th. So we have a low, swing high, swing lower low, and then here on this day on the 28th, we took out the swing high. We now change this into a bullish market structure. We look to the left for the order block. The order block goes right in. I make this go right into the future because I'm not buying the change in market structure. I'm buying a dip to the order block after market structure has changed. You can see on this day we rejected the top of the order block. 1566 was my entry. I position size correctly based upon volatility. I placed my emergency stop 2 ATRs below. My end of bar stops closed below the order block at 1504. I placed my trailing stop level 1.5 ATRs above, and bam, next day, huge move up. I hit multiple profit targets into that strength, got to trailing stop level. Next day, no profit targets, didn't do anything. And then on Thursday, we had a close below a previous bar's low after reaching trailing stop level. What's my rule? My rule is that I get out of half. And so I locked in a profit of 6.01% on that particular day. I still have half of the position. Friday it was up, not enough for a profit target, but up. And so going forward now, if it continues to move up, I will take partial profits, right? If I get to a 70 RSI level, I'll get out of half. After that, if I get out of half and have a close below a previous bar's low, I'm going to get out of the rest. So again, I have rules for everything. This is how you see me every week use this and trade this. And I also teach my students this stuff works. You got to get yourself some rules. If you get it from me or anyone else, great. Just get them and stick to them and use them. So the remaining shares on this particular trade up 6.95%. All right. So those are the current open positions. Google long up 9.89%, Amazon short up 2.41%, and UNG, the remaining shares up 6.95%. Okay. Here is QQQ. I closed out my QQQ long position. This was a fantastic trade. I'll take you through it. The most important part of this, in my opinion, is why I got out of the trade. But just to give you an overview, if you haven't seen this, I bought the Qs right near the bottom on the 8th of April. Rejection of the bullish order block, 1466. Placed my emergency stop 2 ATRs below. My end of bar stop just to close below that order block. Look how close that was. Very good risk to reward ratio. Trailing stop level 1.5 ATRs above. Huge move up. Multiple profits. Got into trailing stop level. We moved sideways for a day. Had some profit targets here. Here on the 16th, first close below the previous bar's low. I got out of half the position for a gain of 6.75%. And then, of course, we just go higher and higher and higher and higher. Here, on the 13th of May, I exited half. Why? It was up so nice. It was, but on this particular day, we went over the 70 RSI and closed below the 70 RSI. If my students are out there watching, my current students are out there watching, they'll see, because this is what I teach them in their classes, but if I reject the 70 RSI intraday, I take half of the position, and that's exactly what I did. So not half, a quarter, because I sold half here, but so I sold half here. Here I'm taking half of a half, so really it's a half of what I have left, but it's a quarter based upon where I started. So we went above 70, below 70 during the day. I took half the position off, 19.21%. And then we went up a little bit, we went up a little bit, we went up a little bit. I didn't really do anything. And then here on the 21st, I exited the entire position. Why? Because I have a rule that I use and I teach. If I reject the 70 RSI, I sell half of what I have remaining. How do I get out of the rest of the trade? If then in the future, if I have a close below a previous bar's low, or I close below the 5 EMA, and you can see on this day, both of those things happen. And it's not surprising. Look at the volume on that day. A lot of professional traders saw these signals, got out of the trade. So the remaining shares that I had on that particular trade, on that last quarter, 18.84%. And I'll go through this a little bit later, but you can see the red order block above as resistance. Look, that's right where the market got to. Very close to the penny, honestly, before it started to move down. So order blocks are no joke. They really work, and they're really helpful in your trade. So learn about them. I can teach you them, or find out some other way, but they are so helpful. I don't care if you trade options. I don't care what you do. I trade options all the time. And I use the order blocks, the bullish and the bearish order blocks, to help me structure and create my trade plans, and I base them around the order blocks. So the remaining shares, I am now out of Qs. That was one hell of a really big up run. I'm out of the Qs. The last portion up 18.84%. Okay, These are the weekly trades. Weekly trades close on Fridays. So I take my trades. This one down. I entered this. I've been in this trade a long time, from January 17th. Why? Well, here's an order block. We rejected the order block. We closed above the order block. I got long 87.20. I position size correctly. My end of bar stop is a close below the order block. My emergency stop is 2 ATRs below my entry. My trailing stop level up here at $90.60. So to take you through the trade, next week went up, no profit target. Next week went up a little bit, one profit target. Next week went up, multiple profit targets. Then a couple days or a couple weeks sideways motion, nothing. Here on the 28th, week of 28th, big ups, multiple profit targets. Month sideways, nothing. Then here on the 4th, big up again, multiple profit targets. I'm in trailing stop level. The next week we had that huge sell off in bonds. Look, I'm in trailing stop mode. So did this bar close below the previous bar's low? Yeah, it certainly did. And I had to lock in a loss of 0.59% here. But keep in mind, I took partial profits on the way up. Makes sense? So that helps mitigate any loss. Then a couple weeks, we kind of went sideways and up, one profit target here. But for the last month, bonds have just been down, down, down. Now it's staying above my end of our stop, the end of the order block. So I'm still long on the trade, and I'm still a bull on the trade until we close underneath. So the remaining shares that I have on TLT down 3.18%. And then last is Nike on the weekly trades. So no order blocks on Nike. This is just a straightforward deep dip buy trade on the weeklies on Nike. I entered on the 18th here at $55.80. Okay, what were the confluences? What were the signals? Two of them. One, on this particular week, we went below the 30 RSI during the week, excuse me, and then we closed above the 30 RSI. If you've taken my deep dip buy course or one of my students, one-on-one students, you'll know that one of the deep dip buy signals is an under 30 during the bar's time and closed above the 30 at the end of the bar, and that's exactly what happened. This week we went under, but closed over the 30 RSI. We also went under and closed over this negative third ATR channel or negative third Keltner channel. 92% of prices when they get to the negative third ATR channel stop going down, move sideways, or move up. So whenever you get to the negative third ATR channel in price, you probably should start looking for a trade there, right? And I don't take a trade just because it goes under the negative third, over the negative third. But in conjunction with the under 30, over 30, see how it sweetens the deal and makes the trade better. So anyway, I got long here, 55.80, placed my emergency stop. Placed my emergency stop 2 ATRs below. My end of our stop is a close below 30 RSI. I placed my trailing stop level 1.5 ATRs above. We have moved up over the last month since I bought it, taken some profits. 2 weeks ago, I got to trailing stop level. What does that mean? That means now in the future, if I have a close below a previous bar's low, I'm going to get out of half of the remaining shares that I had. That happened this week. We closed under the previous bar's low after reaching trailing stop level. So my rules tell me I take off half of the position, and I took off half of the position with a gain of 7.20%. So those are all the trades that I have, the current trades that I have, and some of the trades that I got out of, like the Q. So anyway, hope that gives you a little peek into how I look at things, how I trade, how I set things up. Okay, so let's get on and talk a little bit about trader psychology, and after that we'll take a look at next week's trades. All right. All right, so this comes from John Borman. I, I do this every week where I show these posts and then we kind of riff on them a little bit. But man, this one sentence is just amazing. And it really it's precise. And I like precision. And last week I talked about precision in trading. And really, you need to be precise in your trading. You really do. But this really encompasses everything about trading, my whole trading philosophy. Let's just read it. It's one sentence. You have to be extraordinarily patient with winning trades and ruthless with losing trades. There you go, everybody. That's it. There's your key to the Lamborghini, right? There's the key to your Tesla or the key to your Mercedes or whatever. You have to be extraordinarily patient with winning trades and ruthless with losing trades. In other words, you have to stay in your winning trades and you have to get out of your losing trades. Have you heard this before? Look, you need to be impatient with your losers and patient with your winners. That's exactly what it's saying. But the key is, everyone, how do you become extraordinarily patient with your trades? You have to have a process that tells you to stay in that trade. Look at that QQQ trade I had. I was in it for months. Were there days that I just wanted to bail on it? Yeah, of course. But my rules and my process told me not to. I finally got out last week. Why? Because my rules told me to get out. You've got to get some rules, everyone. You've got to get a process. You can learn it from me. I teach private one-on-one lessons. I teach people from all around the world. I love to teach. I have developed some really great traders, and I'd love to do it with you as well. I'll teach you all my rules. But whether you get them from me or you get them from someone else, you've got to get them so that you ultimately can be extraordinarily patient with your winning trades and ruthless with your losing trades. If you look at my trades, do I have losing trades? Yeah, of course, I have them all the time. But I'm usually in them for 2-3 days and out if I'm wrong. If I'm right, I can be in them for weeks or months. So this is by John Borman. It's great. One more time. You have to be extraordinarily patient with your winning trades and ruthless with your losing trades. Be precise. If your rules tell you to get out, get out. If your rules tell you to stay in, stay in. So thanks, John Borman. Thanks, Tony Stark. Appreciate that. All right, everybody, let's go over and take a look at the potential trades that I'm looking at for next week. And I've got some good ones here. Really, I've got some good ones, a whole variety of different type of strategies. And I always want to start off with this. So look, here is 7 different potential trades for next week. Now, is it possible that all 7 of these could happen on the same day? Of course, they could all happen Monday. Does that mean I would take all 7 of these trades? No, it does not. I only take 1 trade per day on the dailies. I only take 1 trade per week on the weeklies. Something I've been doing for years. It really works for me. And yes, all 7 of these could trigger on Monday. But are all 7 of them going to be equal in the strength of their trade? No. There will be one that is better than all the rest. How do I determine that? I determine it by many different things. And I teach my students this in the one-on-one course that I teach with them. It's very important to be able to narrow down which trade is the best trade. And so I factor in how many confluence signals. If one has 1 signal, but the other stock has 2, which one do you think I'm going to take, right? Maybe one of them has a bounce at the 200, a rejection of the 30 RSI. It's in an order block. It has a V1, right? So I look at all the signals, which one has the most signals, then which one has overall the best risk to reward ratio. That's extremely important as well. Which one looks better on a longer time frame? That's important as well. Which one is weaker or stronger compared to the rest of the market, the relative strength of that? That's important as well. And so this is what I teach my students, everyone. And that's why I would love to have you as a student. Not only do I teach you all 7 of the different trading approaches that I use, I teach you how to narrow down, take the best trade of the day. So my email's in the link in the description. If you want to reach out to me, we can get the conversation started. I'm teaching so many students right now from all over the world. I just want to say hi to them. Pete is from Finland. Vivek is from Canada. I'm teaching Stephen in New York. Andre in Indonesia. So I love meeting these people from all over the world and teaching them to become better traders. So here we go. Let's start on the daily here with Bitcoin. Okay, everyone. Earlier in the podcast, I was talking about abandoned babies and island reversals. Well, this is an abandoned baby on Bitcoin. Look, this is BITO, by the way. We gap up and we gap down. This is a bearish abandoned baby. Going forward, more likely than not, this will be lower than higher. Hate to say that to all you Bitcoin fans out there, but this is just what the charts are saying. So did I enter on this abandoned baby where we gap up followed by immediate gap down? No, I didn't enter it yet. I'm looking for a little bit of a check back. I'm looking for a little bit of a move back up and the rejection of the low of that abandoned baby. Will it happen? I don't know. Maybe it goes straight down from here and I miss the trade. That's fine. But if we do go back up, usually when you have a big move down like this, the market tends to try to go up a little bit. So if we go back up and reject 2331, so we get there, test it, and come back down, that would be the trade for me. And at that point, I would position size, get short, 2 ATR stop loss above, 4 ATR profit target below, just like on Amazon. So that's what I'm looking for. I'm looking for a little bit of a counter rally back up to the bottom of that island reversal, abandoned baby, to get short. So looking to get short on BITO. Berkshire Hathaway, BRKB. All right, so we have a couple things going on here with BRKB, both potential long and potential short. Up here is the bearish order block because we have a high. This is opposite of the bulls, but we have a high, swing low, swing high, market structure change. This makes this the bearish area. However, we have a bullish order block below us here as well in the green. Now, this bullish order block is so wide, there is no way I'm taking the trade up here and placing my stop down here. And I fully don't expect this to happen, but if it does happen, I would take the trade in a second. You see the 200-day moving average. Here's the 250-day moving average. And also a 30 RSI will reside also here in this bullish order block. So from a deep dip buy perspective, it's unlikely that we're going to get down to the 200 or the 250 or the 30 RSI. But if we do from a deep dip buy perspective, and this deep dip buy happens in this order block, I would be very, very interested in that trade, right? Deep dip buys are 300 SMA, 250 SMA, 200 SMA, 30 RSI. These are all deep dip buy signals. But when they happen inside an order block, it really improves. And oh yeah, by the way, speaking of deep dip buys, I teach these in my one-on-one class, but I also have a really great online video class on udemy.com where I teach you just the deep dip buy strategy. It's 9.5 hours of video, and it's in the link to the Udemy courses in the description of this YouTube. So if you're interested in deep dip buys, but you're not able to do the one-on-one with me, that's available to you as well. So back to Berkshire. So yeah, we have this really wide green order block. I'm not going to mess with it up here. If we get down to the 200, 250, this is where I would be looking to buy. Conversely, if we rally back up and reject the high of the order block, I would be looking to short. So it's just kind of stuck in the middle here, resistance above, below, but a really high quality trade would be that 200-day moving average or the 250 moving average for a deep dip buy signal inside the bullish order block. Okay, let's go to DIA. Well, DIA is the Dow Jones Industrial. You see a red box. I'm looking for a short. Why a short? Well, here on the 19th or the 12th, excuse me, of May, we have a swing high, followed by a swing low, followed by a swing high. Last week we broke structure by taking out the swing low. So keep this in mind, everyone. You know, we on this index we have broken structure to the downside. Doesn't mean we can't go up, make new highs here with this, but the structure of the chart has changed from clearly bullish to now bearish because we have a swing high, swing low, swing high, market structure change. Once you have that market structure change, very often you will come back up, attempt to rally. So going forward here, look, there's the 200-day moving average. Usually you buy from that, Greg, right? Yes, I do on a deep dip buy. But now we have the 200-day moving average above us as resistance, and it also resides inside the bearish order block, which makes this a very, very strong bearish signal. If next week we go up, reject that 200-day moving average, I would very likely get short there. Where would my stop be? Would it be at the top of the order block? Close at the top of the order block? No. When I have a major moving average that lives inside the order block, the nice thing about having that 200 or that 250 or that 300 is that if it rejects it and then the next day just closes back above, now I can simply get out. See, when you're just using the order blocks, you have a little bit wider of a stop. But when you have a 200, 250, 300 inside, then you can just use that 200 or that major moving average as your line in the sand. If I'm short, as long as it's under the 200, I'm staying short. If it closes back above, I'm just down. All right, so that's what I'm looking for next week is a rejection of that 200-day moving average. And I mean rejection by it touches it and closes underneath. Now, if it closes back above, do I get short? No. But if it then from there goes up higher and rejects the high of the order block, I could get short from there. That would be the best because the risk to rewards ratio is the best. So essentially on DIA, really what I'm looking for next week is a rejection of the 200-day moving average to the downside to get short. FedEx, okay. You have a green box down here. That's your bullish order block. Why is this the order block? Well, look, here on the 25th, we have a swing low, followed by a swing low, followed by a, swing low, followed by a swing high, followed by a lower swing low. Market structure change. Did the market structure change call it? Yeah, kind of did. But once you change market structure to the upside, now this lowest bar close, the high and the low, become your bullish order block. You move the order block into the future. And now if we reject the high of this order block, reject the low of this order block, potential long entry. See, the key is when you change market structure to the upside, I don't buy the market structure change to the upside. But I like to buy the dip after the market structure changes. There's the old saying, right? Buy dips in an uptrend, sell rallies in a downtrend. Well, this is exactly what this is doing. The market structure change is putting you into a bullish uptrend. I'm just buying the dip back to the order block. That's buying the dip in the uptrend. Conversely, on DIA that I just showed you, we just changed market structure to the downside, so I'm looking to sell the rally or sell the rip. Buy dips in an uptrend, sell rips in a downtrend. This is a perfect example on DIA, selling a rip because we change into a downtrend. FedEx, buying a dip to the order block because we change market structure to the upside. Make sense? Order blocks are great. Order blocks are great. They help you with so many things. Learn about them. I'm happy to teach you. But I day trade all day long, and I do a lot with credit spreads. I do a lot with options. Actually, I do a ton with options, and I base them all around the order blocks. Whether I'm selling credit spreads, iron condors, cover calls, everything that I do, everything in my trading life really revolves around order blocks, and it's so important. So let's go to, so are we straight on FDX then? We change market structure to the upside, looking for a pullback rejection of the high of the order block. The high of the order block is 210.60. The low of the order block is 204.33. So rejection of the high of the order block, rejection of the low of the order block. GLD. Okay. Well, you see a lot of red up here. That means I'm looking to short. Look right here. Over here. Abandon island reversal. What makes it an island reversal? We gap up. More than one bar, gap down. Looking out in the future, was it lower? Yeah, it certainly was, based upon that. Now, we've had a rally, but I'm looking to short the rally. Why? Well, because even though this looks very strong, we've changed market structure to the downside. We have a swing high, followed by a swing low, followed by a swing high. In this area, we take out the swing low, meaning that we've changed market structure to the downside, making this now the order block, the bearish order block, 315.62 to 311.40. Move that out into space there. So I'm looking to get short gold. Where? One of three locations in this particular setup. A rejection of the low of the order block, 311.40. That would be one potential. A rejection of this red line in the middle of the order block, 313. What's important about that one? Well, look at the big down bar over here on the 22nd, the big down bar. If you have a big down bar like this and you rally to halfway, you're going to have inherent resistance. These resistance levels going into the future hold memory. That's why I drew the line out into the future. And look, that resistance level resides inside the bearish order block. So do you see why if we reject that 313.90 level, that would be a good shortable area for me? So with the rejection of the low at the order block at 311.40, a rejection of the midway of the big down bar at 313.90, or a rejection of the high of the order block at 315.62. So those are the three levels that I'm looking to potentially short gold GLD. McDonald's. All right, we have a nice little bullish order block down here. It's not there yet, nothing to do yet. And again, why is this an order block? In this area here, we have a swing low. In this area here, we have a swing high. In this area here, we have a lower swing low. Would you agree? Swing low, swing high, swing low. What changes market structure if we take out that first swing high? Did we take out the first swing high at the beginning of the week? We did. Making this bar the lowest bar close before market structure change your bullish order block. Have we gone down or rejected the high of the order block? No, we have not. So going forward next week, if we reject the high of the order block is 308.91, that's potential. Or the low, 305.69, is also the other. Do I have a preference? Yeah, I'd rather take the low one. Why? Because the risk to reward's better. Right? Risk to reward is huge. So I'm looking for a bit of a pullback on McDonald's, either rejection of 308.91 or rejection of 305.69 next week in the bullish order block. And then last but not least on the dailies, Shopify. This is a nice little setup. This is a combination of a bullish order block with a deep dip buy happening in pretty close to the same spot. So why the bullish order block? Let's work with that first. We have a swing low here, followed by a swing high here, followed by a lower swing low here. Swing low, swing high, swing low. We need to take out that swing high in order to change market structure to the upside. Did it happen? Yeah, sure did. Makes this the bullish order block. Bullish order block going out into the future. The 200-day does not reside in the order block. It'd be better if it did, but it's pretty dang close. So next week, two options. Because the bullish order block is so close to the 200, I kind of just consider it that it's in about the same location. So just any rejection of the 200 next week would be an interesting spot for me to get long. Conversely, if it comes down, closes below the 200, yet rejects the high of the order block, I would consider getting long there as well. And the high is 94.91. So rejection of 94.91 or rejection of the 200 at 95.42, basically just somewhere in this area. Now, if we go lower, the ideal spot would be here. Do you see the 250-day moving average, the purple line? I know it's a little hard to see, but you see how it is now living inside of the order block? That would be the ideal. Really, that would be the ideal for multiple reasons. One, it's lower. It's at the low of the order block, the 250. So the 250 there is 89.28. That's quite a long ways down. Don't know if that's going to happen, but if it did, that would be perfection because we're at the low of the bullish order block. We are at the and the 250 resides in there. So I'm not expecting it to go down that far. Who knows? You never know. But multiple areas to look out for Shopify. One, a rejection of the 200-day moving average. That's simple. Two, a rejection of the high of the order block, 94.91. Those are the more likely scenarios. But if we go much lower, a rejection of the 250-day in the order block would be fantastic. So those are the dailies. Let's move on to the weeklies. Yeah. All right. Well, talking about pretty sweet trades. And again, I don't know if they're going to get here. If they do, very likely I would take this trade on Apple. But whether it gets there or not is a whole other thing. What do I like so much about this trade on Apple? Take a look at it for a second. Before I tell you, try to come up with your own answer. You got it? Perfect. Okay. There are multiple levels here, but let's start with the order block in general. This order block was formed all the way back 4/19/24, over a year ago. These things hold memory. Why is this an order block? We have a swing low here. We have a swing high here. We have a lower swing low here. We take out the swing high, changing it into a bullish market structure. Was it right? Yeah, sure was. Now this creates the order block. This bar here on the 19th, the high is 175.51, the low is 163.09. Move that into the future. That is your order block. I like to teach my students, tell each one of my students this. Look, when the market was up here and the market was up here, in hindsight, it's very easy to see that this area smart money was buying. Would you agree? At the time, it didn't look too smart, but after the fact, when you look up here and you look up here, clearly smart money was buying here, right? So this is the smart money area. Instead of calling them order blocks, we might just call them smart money areas. SMAs, right? Now, in the future, if we come down to that smart money area, are they still smart money areas? In my experience, more times than not. Sometimes they don't work because things change, the economy changes, world politics change, macroeconomic things change. So what once was smart money doesn't have to be smart money, but more times than not, it is still smart money. And look, back here in April at the lows, where did Apple bounce? In the smart money area. You see that? So going forward, what do I do with Apple? Well, there's multiple locations. A move down, and Apple's been weak, no doubt about it. A move down and a rejection of the 200-week moving average, yes, 100%, I would consider taking the trade. That's the first level I'm looking at. The second level I'm looking at is rejection of the high of the order block. That's 175.57. So the 200 is 178.45. Look for that level first. Second level, I'm looking for rejection of the high of the order block at 175.57. Always the low of the order block would be legitimate too at 163.09. But when I asked you the question earlier, where's my favorite? Look, it's the 250-week moving average that lives inside the order block, right there. So three levels. First stop, rejection of the 200-week moving average. Second, rejection of the high of the order block at 175.57. My favorite, rejection of the 250-day moving average inside the order block, 167.46. And lastly, a rejection of the low of the order block at 163.09. So it may not get there, folks. It really may not get there. But if it does get there, I definitely would consider taking the trade. Boeing. Okay. So Boeing has just gone straight up, right? It's gone straight up. Now, we had a market structure change. Let me just identify it for you. Here's the swing low. Here's the swing high. Here's the swing low. We change market structure to the upside, making which one the order block? Well, this one. But that is a wide order block. More likely, what's going to happen if we do pull back, it's right to here. Deep dip buy back to the 200-week moving average. So I'm really not talking about this order block here. Yeah, if it moves back down, more than likely it will bounce somewhere in this area. But it's too wide of a range for me without any moving averages that live inside it. So what I'm looking at for Boeing is just a bit of a pullback back, just straight deep dip buy on this one, just straight deep dip buy with the rejection back, the rejection of the 200-week moving average. So it comes back, rejects that 200-week moving average. That would make sense. Not surprising at all that we'd have a pullback and a retest of that 200-week moving average. And the benefit of that is if it does reject it and gives you a good risk to reward ratio of that 200, then it's just a very simple line in the sand. Under, I'm out. Over, I stay in. So that makes sense. So what is that, 187.72? So it's certainly possible that we could get down there. Very likely, I think we'll find some support there, but I'd have to have a bounce or an inter-week rejection of the 200-week, give me a good risk to reward ratio. That would be my potential entry, and then close with my stop would be a close below 200. Let's go to the Russell 2000. Very similar, actually. And on the Russell 2000, you see the green box. That's the order box. Swing low, swing high, swing low. 2 weeks ago, we took out the swing high, changing it into a bullish market structure. And this is what I love to see. I love to see the deep dip buy moving averages inside the order block. This is a very wide order block. I don't want to buy here with this my stop here, but that's why I love having the major moving average is inside the order block, because then it gives me a very good risk to reward ratio and line on the sand. So we did pull back. We have not rejected the 200-week moving average. So next week, if we reject the 200-day moving average, 200-week moving average, meaning that we bounce and close above it, or we go below it during the week and then close above it, then that would be a very good entry there at the 200. All right, next, S&P 500. This one, it's just so pure and so perfect. But look, we have a bearish order block here on the weekly. Why is it a bearish order block? Because back here on the 24th, we have a swing high, followed by a swing low, followed by a swing high, market structure break to the downside, going back up into the bearish order block. You can see we haven't got there, but we're getting pretty close. 3 levels. The low of the order block, not 598.51. Bar in the middle, rejection of 605. Why? Because that's halfway the big down bar here on the 21st, or a rejection of the high of the order block at 610.99. So somewhere in this area here, rejection of the bottom of the order block, the top of the order block, or rejection of 605 in the middle is what I'm looking to short. Look, we've had this huge, things don't just go straight up, right? And we're coming into major order block resistance. So I personally will be looking to add more shorts if the market rallies from here. But that's what I'm looking at short on SPY. Let's look at Tesla. Okay. Tesla has created a nice bullish order block. Swing low, swing high, lower swing low, market structure change. Market structure change is the order block. Look what lives inside the order block, the 200-week moving average. I drew the green line here. That would be the ideal spot for me to enter Tesla. I'm not going to chase Tesla up here after this huge move up. But we have changed market structure to the upside. A pullback to the 200-day moving average is unlikely. I understand that. But if it happens and I get a rejection of the 200-week in the order block, potentially get long there. UUP is the dollar. You've probably heard news about the dollar, how weak it's getting. Yeah, I would say, look at that. But look at this unbelievable confluence here. We have an order block. Why? Well, go all the way back to 2023. Swing low, swing high, swing low. Market structure change, was it correct? Sure was. Was that the smart, when we're up here, end of 24, was that smart money? It certainly was. We draw the smart money out into the future. Look where it dovetails. 1, 2, 3, 4, 5 weeks ago exactly it got into the smart money area and bounced, didn't it? Now we may be coming back down into the smart money area. So I'm looking to potentially get long the dollar with the rejection of the high of the order block, 27.13, the low of the order block, 26.92, or look at the 200-week moving average creeping right into the order block, right about here. If it gets down there and rejects that 200, yeah, I would definitely consider taking it. So this is what I'm talking about, everyone, where you can sit and look and go, oh gosh, if it got there, that would be the perfect spot. Well, that's the perfect spot. It still doesn't mean it's going to be a winning trade, but that's the perfect spot to take a trade as long as you have your rules in place, as long as you have your end of bar stop very, very close. Right? You don't just buy there and it keeps going down. You got to get out, but that's your line in the sand. But if we came down and rejected the 200-week moving average, I'd be very, very inclined to take that trade. Walmart, bearish order block. Swing high, swing low, higher swing high. Market structure change, making this the order block. 104.76 to $100.73. We are coming right back up into the bearish order block have not rejected the bottom of it, have not rejected the top of it. So potentially to get short Walmart, rejection of $100.73 or rejection of the high 104.76. So looking to get short somewhere in this area. And last but not least, everyone, I've been really bullish on healthcare. Not that it looks very bullish. That's why I'm bullish, because it looks very bearish, right? But look at this beautiful order block here. Happened here on the 27th. Swing low, swing high, swing low. Market structure change. When you're way up here, was this a smart money area here in the green? Yeah, it was. Clearly. And now we're coming back down into it. And what I like so much about XLV is that we're coming into the bullish order block. Look, 2 weeks ago it already rejected the order block and bounced, but now we're coming back down a little bit. That 300-week moving average lives right in the bullish order block. Those are two extremely bullish areas that I'll be looking to get long. So anyway, that is those are the dailies and the weeklies. I hope you found that helpful. Like I said, if you did find anything helpful in the podcast today, I really would appreciate it if you could hit the thumbs up button, share the podcast, subscribe. That would be great. If I could help you with your trading, I'd love to be your coach. I'd love to be your mentor. I have a 15-hour one-on-one course that I teach. Like I said before, I teach people from all over the world. I love to teach. I love seeing my students learn something new, having those aha moments, seeing their trades, watch them, their improvement. And I can do that for you as well. Teach you all the different strategies that I use, teach you all about order blocks. If you like to do options, that kind of stuff, I teach that too, because I trade them every single day. So, it's an investment in yourself. It's an investment in learning a new skill, and I would love to teach you that new skill. Again, if you like a video course better, I have a great video course available on udemy.com. The Deep Dip Buy, you can check that out. It's very affordable. It's 9.5 hours of video. That's a great place to start. But I really appreciate you being here. I hope you have a nice, long, extended holiday weekend. Please try to go out and do something nice for somebody every day. It just makes the world a better place if we could all do one nice thing for another human being each day. I'm a huge animal lover. I was raised with many animals. And if you could also go out and try to do one nice thing for an animal each day, one act of kindness, they would appreciate it just like we do. And it could perhaps just make the world a better place. And we need that. So if you have any comments or questions about anything I discussed in the podcast today, put them in the comment section. Do my very best to get back to you. But again, I appreciate your time. I appreciate you taking out of your busy schedule, watching this, and I hope it was helpful for you. And I hope that you got some kind of return on your time investment. All right. So thank you so much, everyone. On the way out here, I have to run the U.S. legal disclaimer, and God willing, I will see you next week. Thanks again, everyone. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.